Hello everyone and welcome back to NAPS, which stands Nonprofit Auditor Points, and I'm Irina Ryshkova, your nonprofit auditor. In our last episode, we started talking about fixed assets, and we introduced the basic concept of fixed assets and discussed what generally makes something a fixed asset rather than regular ordinary expense. Today we will continue that discussion by moving into most important practice area of fixed assets policy and capitalization threshold. Pretty much the procedure that defines fixed assets capitalization process. This is the area that creates a lot of confusions for some nonprofit organizations because many people believe there is some official rule that exists where it says that there is a certain asset that needs to be capitalized. There is a specific threshold. But in practice, it's not that simple. GAAP, General Accepted Accounting Principle, does not offer universal capitalization threshold that applies to every nonprofit organization. Instead, every nonprofit is expected to establish its own reasonable accounting policy based on the many factors. But primarily, nonprofits need to consider size of nonprofit organization, size of fixed assets overall that organization has, nature of its operation, and practical administrative consideration. And once the policy is established, it's important to be consistent with application of such policy. So today we're going to talk about why organizations need a fixed asset policy, how capitalization threshold works, why consistency matters, and why auditors care about those policies. Okay, so let's start with a bigger picture. Why does nonprofit even need a capitalization policy? And the answer is actually very practical and hopefully straightforward. Without the policy, organizations often handle similar purchases differently depending who is recording transaction. And one person might decide it is a fixed assets, and maybe because everything above $1,000 needs to be capitalized, and another person might think $2,000 is not that expensive and they will expense it. Therefore, in order to have a consistent application and proper accounting records, nonprofits have to have a capitalization policy. Otherwise, inconsistency creates confusion, inaccurate records, and sometimes problems during the audit. A written fixed asset policy helps the organization create consistency and avoid unnecessary judgment calls every time when equipment or property is purchased. It also helps the organization to avoid another common problem, which is tracking too many small or insignificant items as a fixed assets. We need to remember that maintaining fixed asset schedule can be time demanding, and all of this effort, maintaining fixed assets, inventory them, tracking them, can be time consuming and not necessarily needed. So for example, suppose nonprofit will start capitalizing some small chair, computer supplies, coffee makers, lamps, small printers, and other low-cost electronics. Are they important for nonprofit? Absolutely. But do we need to record them as a fixed assets? Most likely not. Technically, some of those items may last for more than 1 year, maybe just more than 5 years, but should not be most likely fixed assets. At some point, tracking hundreds of very small items creates more administrative work than useful accounting information is needed. That's one reason why capitalization threshold exists. A capitalization threshold is simply a minimum amount at which the organization will generally record item as a fixed item versus expenses it right away. For example, one nonprofit can decide that purchases under $2,500 are expensed. So we're not gonna capitalize because they're not material enough. For other nonprofit can decide $1,000. Some nonprofit can even decide $5,000. Nonprofit can come up with its own reasonable capitalization threshold. Again, it is important to remember that under GAAP, there is no precise capitalization threshold exists. It needs to come from a nonprofit and needs to be reasonable and approved by the board. Once the policy is established, it needs to be distributed to accounting staff, to program staff, and the organization needs to follow and apply that policy consistently. Sometimes $4,000 capitalization threshold can be too big for small nonprofit, but for large organization, it could be not even big enough. So materiality and overall size of nonprofit is really critical for determining threshold. And the policy should be reasonable for the organization, also practical, and applied consistently. Now, one thing that sometimes creates confusion in a nonprofit organization is when different approaches used for different assets. For example, computers, furniture, vehicles, food improvements, or specialized equipment may not always be treated exactly the same way. Some organizations may establish separate thresholds or additional procedures for certain asset categories, and it is allowable. And sometimes group of purchase becomes significant even if individual item is relatively small. For example, imagine a nonprofit purchases 30 tables for a classroom program. Individual each table may fall below the threshold, but collectively total purchase may be significant enough, and the management can decide that purchase should be tracked as a fixed asset group, all 30 tables that belongs to one classroom. Now let's talk briefly about useful lives and depreciation methods. We're not gonna go too deep into depreciation yet because we will have an entire episode about this topic. But the fixed asset policy normally includes estimated useful lives for major asset categories, meaning that each different class of asset should have their own useful life. Remember, this is just an estimate and this is a accounting number. Nothing to do with the real life, how long this asset can be used or live, right? For example, computers may be assigned useful life 3 to 5 years, or it can just say we're gonna useful life for all computers 3 years. Furnitures can be 5 to 10 years. The organization can decide, for example, all furniture gonna be depreciated over 7 years, right? Vehicles 5 to 7 years. Buildings maybe 20 to 40 years depending on the nature of the property. Useful lives are not always identical from one organization to another, and they depend again on many various factors. How organization uses the asset, expected wear and tear, technological obsolescence, legal and contractual limitations, and other organizations' experiences with the similar assets. Most nonprofit organizations use straight line depreciation for financial statement purposes because it's a simple, consistent, and generally aligns with how nonprofits use their asset. Under the straight line method, the same amount of depreciation is recorded on books as an expense over the useful life of the asset. Again, it's consistent and easy to use. And straight line method, it's method in accordance with general accepted accounting principles. Organizations should avoid constantly changing useful life or depreciation methods without a valid reason. Sometimes that reason can exist, and if change happens, it needs to be again approved as a new policy that the organization changing useful life of the assets, and the policy needs to be approved by the board. Okay, now let's talk about the auditor, why auditors care so much about fixed asset policies. From the audit perspective, capitalization threshold, useful life, depreciation method of accounting estimates, and accounting policies have to be applied consistently. Auditors wants to see that organization, first of all, has a policy, that policy is reasonable, that policy have been followed and implemented consistently, and the policy does not create material misstatements for financial statements. Auditors audit fixed assets maintenance, depreciation based on that policy. Without the policy, auditors do not understand what methodology nonprofit followed to maintain fixed assets. For example, if one year the organization expensed equipment purchased and the next year capitalizes similar purchases without explanation, that's inconsistency may create a concern for auditors. Similarly, if useful life seems unrealistic or constantly changing, auditors will have questions why one asset has been recorded, another asset has been expensed. And for nonprofits receiving government funding or subject to additional oversight, fixed assets tracking and consistency may become even more important because of the public accounting consideration, because based on funders' requirement, the nonprofit needs to follow specific policy. So before we finish in today's episode, let's summarize the key area. If the fixed assets, exists those assets that helps organizations create consistency, avoid unnecessary confusion, establish policy and procedure, should establish reasonable capitalization threshold, define useful lives of the assets and depreciation methods, and nonprofits have to maintain accurate financial reporting with the fixed assets. Okay, probably the most important practical takeaway from today's episode is that there is usually not one perfect capitalization threshold that applies to every nonprofit organization. What matters, most of the organization adopts a reasonable policy that should be applied consistently for that nonprofit. In the next episode, we are going to move from policy into practice and discuss how fixed assets should be recorded from accounting standpoint, what costs should be capitalized, what costs should not be capitalized, and some of the most mistakes that organizations make during the recording process. Thank you so much for being here today with me. Looking forward to see you next time for our continued discussion on fixed assets. Have a wonderful day.